So let's say that Indian holding companies there, and it is earning income from outside India. Okay, it is providing services to a non-resident outside India. So similarly, on the converse side, for the Indian business or the Indian individual who's earning income from outside India, there would be a TDS in that country. Okay, so it should not so happen that there is taxation in India also, and then there is taxation in the other country also. So that is where the DTA will come into play. And as per the DTA, you would be granted a credit of those taxes in India if the residence country does not already contain certain provisions which allow you credit of that. So luckily, India has those provisions wherein even if you don't have a DTA, you would not be doubly taxed on the income.
All right, so hey guys, welcome back to the 101 session with a thought leader once again on Seekho. And for today, we have once again a new thought leader with us. His name is Harshal. Harshal actually would be sharing, some great knowledge about tax and international, taxations and many things. But with respect to his profile, since he is right beside me, so Harshal, why don't you go ahead and help the audience as to who is Harshal?
Yes, thank you, Siddharth. So I am glad to be on the show. Thank you for inviting me. And I hope that the next few minutes would be some value add for the audience. So my background is that I am a cross-border tax enthusiast, cross-border foreign exchange regulation enthusiast. So basically, I advise on the cross-border investments and the transactions that go on. So a lot of regulatory and tax aspects need to be looked into by individuals and businesses who want to invest outside India, for the foreign businesses who want to invest into India. So my specialization is into that. And I also share the pleasure of having served a lot of NRIs who are settled abroad. And it is always my constant endeavor to make their life simple in India. So that is a brief background. Yeah.
So the last bit was definitely one important fact. So yeah, I'm sure that this is one heavy thing to do. But great, Ashil. Thank you so much for obviously taking time out of your busy schedule and being here available for a
My pleasure.
one-on-one session. So truly honored to have you, and obviously going forward. So we'll just start right away with the main, the discussion point. So to be very honest, even I am really looking forward to learn a little bit more because I myself I am aware of those terms, but not in detail. So probably I am counting as one of the students, who's looking forward to hearing the insights from you from the one-on-one
Yeah.
session. So to start right away, Harshal, with respect to since we obviously have heard about the international tax and foreign transaction fee, but before we head there, so first of all, if you can help us with what do you mean by the term international tax, and how is it different from the practice of Indian income tax?
Yes, yes, surely. So, for starters, there is not much difference between both. I'll just give you a background. For practice of Indian income tax, there is a proper legislation which is there. That is the Income Tax Act 1961. Then there are rules 19 Income Tax Rules 1962. Then there is jurisprudence which is there. So once you have background of that, so there is a proper legislation when it comes to the Indian context. When you go to the international tax, there is no law as such. There is no supranational law just like you have in India. It is plainly an interaction between the domestic tax systems of two countries and intertwined with the double taxation avoidance agreements that any two countries would sign. And nowadays, there is a flavor of multilateral tax agreements which are there. So after you have a background of the Indian tax law, you just have to build upon that, try to get an insight into the DTA that India would have signed with the other country and where the taxpayer is coming from. And that is how you just have to read in conjunction with these two. And that is how you actually deal with international tax.
Got it. Perfect. Like I said, this is something new and a little more of an insight for me. So now looking forward to the other bits too. So moving on, Harshal, so the next talking point is basically, the next important concept, I would rather call it, is the DDAA. So first of all, we come to the next, as in, for what do you mean by DDAAs? For if you can help us in a layman terms for the people to understand, and then how do they actually operate?
Yes, yes. So, as I gave us a little bit of background in the first question, after you get to know and practice the Indian income tax law, you have to then try to get acquainted with DTAs in order to address cross-border tax situations. So DTAs are nothing but double taxation avoidance agreements. It is a simple agreement that is entered into by two sovereign nations. It's kind of a give and take that, in certain investment scenarios, I am giving you certain concessions for lower withholding tax, that is TDS, for your residents investing into my country, and vice versa. So just to give you a simple example, so let's say an Indian business wants to expand into the foreign market, and it wants to do a certain marketing campaign, and it engages a foreign consultant, and it will have to pay certain professional fees. So when it has to pay professional fees to the non-resident, there'll be a certain TDS. So that is a withholding tax aspect that will come into play. Just as if, when you are making payment to another Indian resident, there is a TDS component on the income that you pay. Similarly, for a non-resident also, you need to pay certain, need to withhold TDS when making payment to that person. Now, when you are withholding that payment, you can take recourse to the DTA, that is a double taxation avoidance agreement. And in the DTA, it may be noted that the TDS may be reduced by a certain percentage. So, say suppose the normal TDS percentage is 20%. Is a fictional percentage that I'm placing before you, and as per the DTA, it may be reduced to maybe 10%. So that is a benefit that the DTA will give to the non-resident who is actually earning the income from an Indian resident. Now let's take the reverse scenario. So this was a scenario of outbound investment. Okay, making a payment to a non-resident. Let's take a scenario of outbound investment. So let's say that an Indian holding company is there, and it is earning income from outside India. Okay, it is providing services to a non-resident outside India. So similarly, on the converse side, for the Indian business or the Indian individual who's earning income from outside India, there would be a TDS in that country. Okay, so it should not so happen that there is taxation in India also, and then there is taxation in the other country also. So that is where the DTA will come into play. And as per the DTA, you would be granted a credit of those taxes in India if the residence country does not already contain certain provisions which allow you credit of that. So luckily India has those provisions wherein even if you don't have a DTA, you would not be doubly taxed on the income. But if you have a DTA and then there are certain beneficial provisions, then DTA will certainly come to the rescue. So one of the main provisions and one of the main objectives of the DTA is to relieve double taxation. And apart from that, there are certain other provisions like exchange of information which is there. So if there is certain fishy business that is going on, the Indian tax authority can actually request information from the tax authority of the other country. So that is also one of the other important objectives of the DTA. So this is the brief background of DTA.
Got it. So I must say, Harshal. So though it sounds obviously complicated for even a layman, the best part was that how you summarized it and put it in the best capsule that one can actually look
Yes.
into. So thank you so much for framing that answer in the best and the simplest manner. So
Yes.
now, yeah, sorry, you were saying something.
No, I was just saying it is not all that difficult as it sounds. It is, yeah, it is plain simple, study of laws and the DTAs, and then you get into practice and it comes in your stride.
Got it. Got it. So, moving on to the next basic question that probably I would love to talk about is basically the transfer pricing. So, the transfer pricing seems to be probably, I would say, the flavor of the recent times. But at the same point in time, for again for the youth, as to if you can help us as to what is meant by transfer pricing, and probably just to add on to it would be, how does the transfer pricing actually help companies, shift their tax liabilities?
Yes, yes. So I'll address the first question. What is transfer pricing? So transfer pricing is basically an economic concept, and then there are laws which are enacted in embodying that concept. So if there were no transfer pricing, let's take hypothetically the situation that you have a related party outside India, and in that country the tax rate is lower than in India. So in India, let's take for an example, the standard tax rate is 25% for any company, and in another country the tax rate is 15%. So you have a tax advantage there. So how do you leverage this gap? So you can leverage this gap by mispricing the transactions between the two entities, your related party situated in that country and the Indian entity. So say suppose you are making a sale of 100 rupees. Okay. So if transfer pricing regulations were not there, what would you have done? You would have actually sold at a lower rate. By doing that, say 75 rupees, 25 rupees of income you're shifting in the foreign country, so that it will be taxed at a rate of 15% rather than at the rate of 25% here. On the other hand, if there is expenditure, if you are making payment to a related party, since the tax rate is higher in India, the tax deduction would be more advantageous here. So therefore you may want to jack up the expenditure when you are making payment to them. So that is where the transfer pricing legislation and the economic concept also comes into play. So there is a concept of arm's length price which is universally accepted across all the transfer pricing laws in various countries. So you may have a commercial pricing which is there. So say suppose the justified pricing is 100, but you may do it commercial at 75. So transfer pricing will come in and correct that situation, at least from the tax point of view, and tell you that no, it is not 100, it is not 75 rupees sale that you're doing, it is 100 rupees that you need to record and pay tax on. So that is how transfer pricing actually helps avoid companies shift their tax liabilities outside India.
Got it. Got it. So, moving on to the next one, Harshal, is this is primarily about the term FEMA. So, first of all, as to what is FEMA, which is FEMA, and then why is it important in the context of cross-border transactions, since we are obviously talking about international transactions, and now we know the importance about the transfer pricing and all those details. So now, also, why is this specific thing also important in cross-border transactions and investments primarily?
Yes, yes. No, I'm glad you asked this because, along with tax, since we are a country where we do not have full capital convertibility, FEMA, that is Foreign Exchange Management Act 1999, or you may broadly call it the Foreign Exchange Law of India, that also comes into play when you are actually looking at foreign cross-border transactions. So India has full current account convertibility, not capital account convertibility. Now, what do you mean by these terms? Current account convertibility means that if you want to do any current account transaction is plainly where you do not have any cross-border asset or liability. So maybe you are not investing into assets outside India. Some a foreign person or foreign entity is not investing into securities in India. It is pure trade payments. It is pure personal remittances. So all those are on account of the current account transactions. So India has full current account convertibility, meaning that there is no restrictions on drawing foreign exchange uh, from the bankers and dipping into the foreign exchange reserves of India to make that transaction. But when it comes to capital account transactions, that is where we do not have full capital account convertibility, meaning if you want to send across money outside India to purchase a certain asset, to purchase stocks, to purchase immovable property, then you have a cap which is there. So currently the cap is $250,000 per individual. So therefore you have restrictions. It is not that there are no restrictions, there are certain controls in place. So that is why India does not have full capital account convertibility, and that is where, in order to uh, examine certain cross-border investment situations, you do have to look at also the foreign exchange law of India. So, when foreign companies want to invest into India, they need to see, are they allowed to do that? If they are not allowed to do that, then there is no way out. A simplest example is that everyone is aware that Zomato came out with an IPO recently, but not many are aware that if you would go through the red herring prospectus, it has made specific disclaimers as well as disclosures in relation to the foreign exchange law of India. So that itself talks about the significance of the foreign exchange law of India.
Got it. So I must say, if there is anyone watching right now, this is probably the best layman definition and the term that probably you can actually find. So he just mentioned it on Seekho, so please do ensure that you share it further. So Harshal, thanks so much for actually we were primarily focusing on the basic concepts and the basic terminologies which are actually there. So you helped us in cracking them down. So now we are moving a little bit into the nitty gritties and some actual main specific questions. So I wouldn't really call them questions. These are more of discussion points. So the next
Yes.
pointer, which is like more of a specific question, this was a little hot one and probably something that the audience at times get confused with. So can you tell us the difference between tax evasion and tax avoidance? So what's the difference between them? And this is, I know this is a little hot and tricky one, but yeah, would love to hear it from you.
Yes, yes, yes. Okay. So, to explain in very plain language, colloquial language, and, tax evasion is nothing but kind of tax chori. You are plainly not wanting to pay tax. So,
Right.
it is contravening the law also. So, on a serious note, when it comes to tax avoidance, see, tax avoidance, there could be two types of that. There could be permissible types of tax avoidance, there could be impermissible types of tax avoidance, but it is not outrightly banned or illegal or unlawful. Then there is a thin line between that. So, under the income tax law, also, there is a concept of general anti avoidance rules. So in every legislation, there are some kind of anti-avoidance regulations wherein they try to you know avoid the tax avoidance situations which cross the line and transgress into tax evasion. So, for example, there may be a round tripping situation, money going outside India then coming back in another color. There may be situations where there is no commercial substance. Then there are coca companies or shell companies which you incorporate abroad. So those are all situations which carry a little bit of color of impermissible tax avoidance. But there are certain kinds of tax avoidance which may be permissible, because if it is within the four corners of law and you are not contravening the you may be contravening sometimes there is a little bit of confusion. One is the letter of law and second is the intention of the law. There may be situations where you may be contravening the letter of law, but if you comply with the intention of the law, then that could be called as permissible tax avoidance. So to summarize, tax evasion is something that is illegal. Under tax avoidance, it could be on both sides. It could be permissible, it could be impermissible.
Got it. So all the people out there who are probably youngsters or young aspirants who are now venturing into the corporate world, and suddenly this tax thing comes in the picture, and now you have heard about tax evasion and tax avoidance. So guys, please be aware, tax evasion is incorrect, and obviously tax avoidance is
Yeah.
something that you can actually look into, because they, as Harshal rightly said, it has two faces. So now you know as to what's wrong and what's right. Great. So the specific one, next one, Harshal, that we have is this. This is something that, honestly speaking, we have heard a lot, but I doubt that majority of the people have actually known about this. I'm talking about the term as tax haven. So so first of all, what is meant by tax haven, and then what role do they play, in the international tax law?
Yes, yes. So I'll come to it. In recent times, after the the Wall Street crash that happened in 2008, a lot of focus has come, a lot of heat has been turned on the tax havens. So tax havens are nothing but they are jurisdictions which aid and abet tax evasion, and a lot of times the impermissible tax avoidance also. Okay, so let's take for an example, there are jurisdictions which do not levy any tax at all. No corporate law tax, no income tax law, no wealth tax, no inherent tax, no stamp duty, nothing at all. So some prominent examples are, maybe Cayman Island, maybe British Virgin Island, then maybe Bermuda. So these are very prominent tax havens which are there. They are called havens because people flock to those jurisdictions when they don't want to pay tax. They stash their money abroad. But after, as I told you, after the 2008 crisis, a lot of heat has been turned on them, and now slowly and steadily they may die a slow death. We may come to know in the near future, that is another 5 to 10 years, a lot of developments are happening. Let's take for an example, a very big company like Apple. Apple never paid taxes in US. Apple never paid taxes in Ireland, where it had a very important subsidiary. Apple never paid taxes in Europe. Apple never paid taxes in Asia. When I talk about never paid, it's a relative term. It's not that they didn't pay even a single dollar or a single rupee of tax. So relatively, they didn't pay taxes compared to the income that they actually earn from these jurisdictions. The income that they earn from India, the income that they earn from Europe, that is UK, maybe Germany, France, and all those countries. And they employed a tax avoidance mechanism. So at that point in time, it was popularly known as double Irish sandwich structure, wherein all the income used to first flow to Netherlands entity, from there to Ireland, and then there from there to Bermuda. So even US lost out on the taxes. So that is how it actually gained a lot of traction. You may have also heard, maybe 3 to 4 years back, a lot of heat was turned on Starbucks also in UK. Starbucks voluntarily paid taxes. There is no concept of voluntary payment of taxes. There was so much bad PR about Starbucks in UK that Starbucks actually paid voluntary taxes. So all this is basically enabled by the tax havens, wherein you can try to dodge the taxes in high tax jurisdictions and stash your money in the tax havens. But you may also be aware about the Panama leaks which are there, and subsequently so many leaks that have happened, because of which now tax havens are really in the limelight. And in the future, maybe they will also have to introduce minimum basic level rate of taxation. A lot of developments going on right now, and if they may have to introduce the basic minimum level of taxation, then they may lose their flavor altogether. It's a game that everyone is very watching very in an interesting mode, and we will come to know in the near future. Yeah.
Got it. So, Harshal, I must say, so thank you so much for actually sharing examples specifically on the answer, because you actually completed a complete holistic picture, and this gives a pretty elaborative detail as to what exactly. It's not just about tax haven. You actually gave a pretty detailed picture about the entire thing. So, thank you so much on that. So, I'm really enjoying this. This is like a more of a
I am glad
probably
you are.
the
I hope the audience also would be. Yes.
Yep, absolutely. So, moving on to the next one. So, the next one is basically about FDI, as to what is FDI, and then what is the broad regulatory regime as in governing the FDI. So, probably we'll first cover this. Then I have a second part of the question. So, I'll probably ask that in as a following question.
Absolutely, sure. So FDI is also a very hot topic. It is nothing but foreign direct investments, and every country needs them. China needs them, India needs it, Philippines needs it, Bangladesh needs it. All the countries need it who are the capital importing countries. Okay. So the capital is typically flown from the capital exporting countries. Those are historically been the developed countries, if you may call them, and the capital flows into the developing countries. So this is the most popular concept. So if I get into the regulatory aspect, then FDI means actually investment into equity instruments of unlisted Indian companies. If it is investment into listed Indian companies, then it is foreign investment but not foreign direct investment. It is a different term that is given, the foreign portfolio investment. So that is typically known as hot money. The FPIs, that is the foreign portfolio institutions, they put in money in the listed companies and they can take out at any point in time. So that is why it is known as hot money. But every country prefers FDI because it is long lasting investment. So say suppose Tesla is wanting to set up a company here. So if it is waiting for actually a reduction in the custom duties, but if that is done, and if it sets up a factory in India, which will be a huge factory, then the Indian entity will need capital. So therefore, the foreign company, that is the foreign entity of Tesla, it may be incorporated anywhere, it may be in the US or it may be outside US or anywhere, that will have to put in money into the share capital of the Indian company, and that will qualify as FDI. So under FDI, there are a lot of rules, regulations. You have to work your way through and try to analyze them. There are many sectors where it is allowed. There are many sectors not allowed. In the sectors that FDI is allowed, there may be terms and conditions that you may have to satisfy. If you are unable to satisfy, then you may not be able to invest. Uh, Another example could be, Yahoo lately shut down their news service in India. Why? Because FDI was restricted up to 26%, that also with the government approval, in news websites. So that is one example of the huge implication of the FDI norms of India.
Got it. So now that we understand, so we have already covered about FDI. So a little bit of an insight, probably, Harshal, as to what is actually India doing to attract, probably, like rightly gave an example of Tesla, and there are many other companies again which are like in the pipeline, basis on the recent news that we have heard. So if you can give a little more insight as to what is India doing to attract more and more FDI.
Yes. So historically, if you see, the economic liberalization started in 1991 when India was in dire straits, and since then there has been no looking back. So slowly and steadily, the FDI norms are being liberalized. More and more sectors are being thrown open to private investment and more so to foreign investors also. Okay. And slowly and steadily, even the rules and regulations are being withheld down so that it becomes easier for the foreign investor to put in money, and at any point in time, they can take out money also. So if you see the trend since 1991 till now, so say, last 30 years or so, slowly and steadily, the economy has been liberalized, and a side effect of that is that the foreign exchange regulations are also being liberalized at the same time. That is, I think, the one focus of any government that may come up at the center in India. You need to liberalize the economy as much as possible so that then there is competition, the economy does not become sluggish at the same time, and at the same time India has a lot of foreign exchange reserves coming in by the way of FDI.
Got it. Perfect. So the next bit is, I would love to hear this because this is once again, this had been in the news for quite a while. We are talking about a little bit about cryptocurrency, I would say. So specifically, I would actually say, so there was a sudden shift specifically in the post-COVID world. that everyone started moving towards, okay, so this is the new thing, cryptocurrency. Let's start. There were news all around as to which cryptocurrency is doing well, how you should invest, and stuff like that. But at the same point in time, probably in a recent masterclass of yours, I would say that you dealt with regulatory aspect of cryptocurrency, right? So first of all, is it legal to invest in cryptocurrency for a layman audience to actually look up to it if someone is wanting to know more? And at the end of the day, how what are the pros and cons, if you can highlight a little bit on with respect to cryptocurrency, looking at the typical mindset of Indians that we have. So your
Yes, yes.
insight on this.
Yes, yes, surely. So the one line short answer is that yes, as of the moment, it is legal to invest in the cryptocurrency in India. But I will still give a little background about the regulatory regime, the challenges that have been faced by the VC exchanges, that is the virtual currency exchanges, like WazirX, Coin, and a lot of other exchanges that are operating in India. So RBI per se and the government has always been cautious in encouraging investments and channelizing the savings into cryptocurrency. The simple reason is that it is very volatile. Okay. And another reason is that it is not backed by the sovereign. It is not recognized by the sovereign. It is an independent currency per se. It has the characteristics of the currency, but it is not legal tender per se in India, and in a lot of countries. You may have heard lately, some South American countries actually legalizing them and making them their national currency. That is a far-fetched thought for a lot of other countries which have put in a lot of thought process in what to do with cryptocurrency. Should we make it legal? Should we not make it legal? Should we ban it? Should we encourage it? So in India in 2017, there was a challenge which was made before the Supreme Court, and then there was a lot of back and forth. RBI was also involved in that, and then RBI put certain affidavits before the Supreme Court. Eventually, Supreme Court ruled that the restrictions which RBI had put on for transactions put on the banks for transactions in cryptocurrency, they were removed. After that, RBI has not come up with any new regulations. So therefore, as on today, as per the Supreme Court decision, investment in and trading also in cryptocurrency is perfectly legal. Let me give you a further background in this. But there is something in the pipeline. It has been in the pipeline since quite some time. In fact, since the past two parliament sessions, there is supposed to be a bill which is supposed to ban the cryptocurrencies, which is to be introduced. But then there is a lot of lobbying, then there's a lot of pressure that now the ecosystem in India has burgeoned a lot. You have so many VC exchanges, you have foreign private equity venture capital putting in money in that, you have so many retail investors putting in money into the cryptocurrency space, into so many cryptocurrencies which are there. So it is not only Bitcoin and Ethereum. There are hundreds of cryptocurrencies that are prevalent right now, and a lot of individuals like you and me are putting in money in that, plainly by seeing the future, that there are certain cryptocurrencies which may help further certain digital systems in the future. So cryptocurrency is basically based on the blockchain concept. So then this blockchain concept can actually have real life use cases which are there. Maybe smart contracts, maybe digitizing the land records. A very simple example is that right now there is a universal pass which has been issued by the government. So if you are staying, I'm not sure it is outside Maharashtra, but at least in Maharashtra, if you are double vaccinated and 15 days have passed, you can apply for the universal pass. And the universal pass is based on the blockchain concept. You will see that when the universal pass is generated, you will see a code which is there. So then nobody can actually modify that. Once it has been issued, nobody can tamper it with that. So therefore, the concept, the technology which is there, blockchain technology, is very well accepted. It is just that cryptocurrency is not that accepted internationally. But as investors, if you want to invest right now, you can plainly go ahead and do. There is no ban as of now. Please bear in mind that select the cryptocurrencies which have certain real life use cases or may have potential use cases, so that there is some underlying backing behind that. It's not pure speculation. Okay, so that is my short advice to investors wanting to invest in cryptocurrency.
So the last part is definitely, one important aspect that you very, rightly touched. So that was a very nice disclaimer at the same point in time, I can call it. And while going for a cryptocurrency, probably this is one thing that you should keep in mind, rather than simply going blindly and, just start investing in cryptocurrency. Great. So we're almost at the end, Harshal. I would love to, in the concluding things, these are a little personal, so would love your insights on this. So the second last point that I have is would love to hear about this. As in, you have authored, two publications with Bloomsbury. And can you tell the audience first of all as to what they are, so that obviously the people can look up to it who are really enjoying the video, and at the same point in time, what are they all about?
Yes, yes. So, these two publications are dealing with the foreign exchange law of India. As we all know, the foreign exchange law is kind of a maze to navigate, and a lot of changes keep happening on and off. You may have seen that, government banning Chinese investments into India. Maybe it will, maybe the restrictions will get lifted off in the future. You never know. And a lot of it is not there in black and white in the foreign exchange law of India. So that is where we came about the idea that RBI used to publish the compounding orders. Compounding is a concept where, if you have actually transgressed or contravened a particular provision of the foreign exchange law, you go to RBI, claim that, I have done this mistake, so please forgive me, pay some little compounding fees and get done with it. So RBI used to publish all these compounding orders, and in the intermittent period, RBI had come out with around 3,000 compounding orders. So what we did is that, for the benefit of all the persons out there who are wanting to invest and, trying to look for certain guidance, which is, if it is not there under law, then we try to find a common line between all the orders. We segregated them into different topics, then we analyzed them, and then we put a thought into it, and then we try to come out with our own conclusions. How does RBI actually view a particular situation? So let's take for a simple example. An individual, an Indian individual, is allowed to make investment into immovable property outside India, but is not allowed to take a loan or a mortgage outside India for investment into property. So there are scores of compounding orders on this point. So not a lot of people are aware about it, even not a lot of practitioners. So not a lot of tax practitioners, foreign exchange law practitioners are aware about it. So that's where we try to put out a common theme, so topic by topic, and then we put it into the book. And uh, all our analysis which is there is proprietary, which you may not find it anywhere. And we thought that, why shouldn't we share it with other persons, and it would really be helpful in their day-to-day transactions, or maybe, even to professionals who are wanting to advise their clients. So that is how we came about with these publications.
Got it. So these definitely seem to be interesting ones. So guys, all the people who are really wanting or aspiring to become, where Harshal is right this very moment, if that's your goal, probably this is definitely one publication that you want to go ahead and read. This could be a good reference. So coming to the last question is Harshal. So for all the, once again, for young aspirants and the students which are there in Seekho, you're pretty strong and have a strong expertise with respect to the international tax practitioner, and obviously there are many people out there who are probably they have set the goal that that's where they want to be, where you are right now. So basis on your journey so far, a little bit of a career advice as to how one should actually plan, what are the right things to actually move the ladder all the way where you are right now. So a little bit of a guidance tip for our students.
Yes, yes. No, my pleasure. In fact, it has been a long road and a long journey for me also. So I would be very happy if I can give some advice, and that could avoid certain pitfalls for other persons wanting to specialize in the fields that I am right now. So one important thing is that how much ever level of specialization is not sufficient. So therefore, don't be disheartened and don't be intimidated that these are very big topics. How am I ever going to learn about them? When am I ever going to master them? So will it take a lifetime of a career to do that? So please don't think about it. Just take a plunge into it. These topics are very interesting. The economy is booming. The economy is opening up. Cross border transactions are going to increase day by day, come what may. So therefore, please aim high, execute right, jot down a strategy. You can take up topic by topic. First, I want to learn foreign exchange law. Start going about it. Then maybe transfer pricing. Then maybe international tax. Then maybe another topic, and then try to build upon that. So don't be disheartened. There will be setbacks, and it comes in everyone's career. So nobody is an exception. So you have to learn to overcome them. And the most important thing is persevere. So don't become complacent. Even as on today, as a practitioner, I have to keep on reading judicial decisions in order to update myself. Every day there is a new development. So therefore, don't become complacent. Keep on persevering, and that is how you will achieve greater heights.
Great. So all the young aspirants who just heard Harshal, so I think the key is perseverance. So yes, keep moving forward. And I think what Harshal rightly mentioned is, just don't give up too easily, despite the fact how intimidating it might sound. Just keep moving forward. So this brings us to the conclusion, Harshal. We are at the end of the 101 session. So thank you so much. I thoroughly enjoyed it. Obviously, learned many new things at the same point in time. So like I said, it was like a student who's doing a sort of a master class altogether. So thank you so much for again
No,
taking time
thank
out
you
and
for
being
the
here.
thank you for the kind words, and yeah, it was really enjoying for me. I always feel that it is our responsibility to give back in the way, in any form that we can, because for all of us it is going to be a tough journey to reach wherever we want. It is always a pleasure to share personal insights to whomever it can help.
Correct, and that's the prime agenda of Seekho altogether. So we are trying our level best to, with credible sources and industry experts as yourself. We are obviously able to deliver the best, knowledge for the people, and that's how Seekho, and obviously with your kind words, that's how we are growing and moving forward day by day. So once again, Harshal, thanks again, and and for all the audience out there who have just watched Harshal's videos and at the same point in time the entire podcast. If in case we bring Harshal back with any masterclass or anything, we'll always keep you posted, and you can always come back for many more things which are coming in from Harshal. So stay tuned, and thank you once again.
Thank you and good luck. Seekho is a very good platform. In fact, I have done one video there, and it's a very novel concept. You don't need to invest much time into learning new things. At least to get to know that there is an entire new world out there, there is a universe of concepts there. Seekho, I think, is a step in the right direction for that.
So tiny steps, micro learning, and you're actually there. That's what I usually say. But yeah,
Yes,
thanks
yes.
once again, and all the people out there. Thank you, and have a great day ahead.
Yeah, thank you.